Good morning, everybody. Welcome to today's 1 million by 1 million strategy roundtable for entrepreneurs. 1M1M, as you know, is the first global virtual accelerator for entrepreneurs. We run it out of Silicon Valley with a global footprint, and our mission is to help 1 million entrepreneurs reach $1 million in annual revenue and beyond, build $1 trillion in global GDP and 10 million jobs. And in support of that mission, for years and years and years, we've done these free roundtables on Thursday mornings, usually Pacific time, 8 a.m. And I know that many of you from many different parts of the world, in many different time zones sometimes, you're staying awake late to be part of this session. So we're very grateful for you to accommodate the time, but this is when we can get most of you to engage. So this is a 350-second session of the 1M1M roundtables. And we started doing this in the fall of 2008, and it's been years of, steady, just being there and doing these working sessions. About 2.5 years ago, we started bringing guests onto the sessions. Before that, it was only entrepreneur pitches, and they've been very, very well received. We've also started releasing the guest interviews as podcasts just as of last week. So if you go to our newly launched podcast channels across multiple different podcast platforms, you'll find at least the first batch of recordings of the prior roundtables there, where we have released the investor interviews so far, and we will release the entrepreneur interviews as well. The event is being recorded. You will find the recording available later on both our blog as well as the YouTube channel. If you're live tweeting, use hashtag 1M1M. Join us on Twitter at 1Mby1M. And at Stromana, we have tons of great content that is flowing through all our social media channels on a continuous basis. We are quite prolific. The YouTube 1M1M Roundtable channel has recordings of every single prior session. So if you want to immerse and learn using this body of work, you're very welcome to go check that out. These are the call-in instructions. We're not quite ready for call-in today. We have a couple of different things that we want to do first, but then we will go to roundtable style conversations and your input, your questions, your participation. We're going to start today with Ron Heinz, founder and managing director of Signal Peak Ventures. Ron, welcome to the show, and it's great to meet you. Is your audio on? Say something, Ron. No, we can't hear you. Is your phone on mute? Ron, it looks like your phone call has dropped. You may need to dial back into the call. All right, so while Ron sets up, let me also speak with those of you who have already come into the room. I know people are still trickling in. Please feel free to introduce yourselves in public chat. Tell us where you're joining from, who you are, what project you're working on, what brings you here, what challenges you're dealing with, and we would like to get to know you as much as possible, and you want to get to know each other. This is a very efficient networking session, actually, where you can network with entrepreneurs in your peer group all over the world. So, so do tell us who you are and where you're joining from.
I should be back now, Shamana.
You are back. Yes.
Okay, good to hear.
Great.
All right.
All right. So, Ron, let's start by having you tell us about Signal Peak Ventures.
Sure. Well, again, pleasure to be here with you, Shamana. So Signal Peak Ventures is a early-stage venture fund out of Salt Lake City. We also have a growth group within our organization, but we have about $500 million under management in the firm. We invest in software companies, mostly Series A and Series D rounds, and our focus is typically in the Mountain West region of the United States. We define that as Utah, Colorado, Arizona, and New Mexico. We do some investing outside of the region, but that is typically more on an opportunistic basis. Maybe we have touch points with entrepreneurs that came in and out of Utah or Colorado. We have worked with them in the past. But for the most focus on the software market, software as a service in particular, and we have a couple different sectors. We have enterprise software, we have a consumer group, and then we have what we call small business and very small business group that looks at various opportunities as well.
So let's focus the discussion on your early stage software SaaS investment activities, and can you double click down and tell us a bit more about what is the investment thesis? What are you thinking? How are you looking at the software industry, its evolution, its current trends, its future, and where are you placing your bets? What is the logic behind what you're doing?
Yep, sure, great question. So first and foremost, we love the software business that has great fundamental underpinnings. You can see a business that typically has a gross margin anywhere between 70 and 90%. Obviously, recurring revenue themes are very, very attractive for us and any other investor, where you have a stream of revenue that you can create over time as the business grows that you can really bank on and count on, and to really build the business in a pretty significant manner. And of course, as you get more growth over several years, then that is really akin to a snowball rolling down the hill, where you have revenue that just grows nicely for the firm. So the fundamentals of the software business are very, very attractive to us, just based on that as a drop back. The second thing that we really like is there are many metrics that you can use across the software market that allow you to measure and manage the company's success. So customer acquisition costs, lifetime value of a customer, a number of different key metrics that you can use and apply across multiple software scenarios, whether those are enterprise software, small business, or consumer-based software. So the drop back in particular for the software market is compelling. We do see businesses that have both an on-premise offering typically, as well as a cloud offering, and sometimes that migration isn't as fast as you would think. Many customers still like a premise-based system, depending on their background and infrastructure, where they may be a government entity or a entity in the intelligence community or military that can't go to the cloud, or if they do have to go to the cloud, they go to a secure. But most of our businesses start to migrate towards a cloud offering, and then have the greater percentage of their business in the cloud, and I think that trend will continue. As mentioned, we like three different sectors in the space. There's three partners at our firm. My specialty is probably more on the enterprise software side. Two other partners have a lot of depth in both the consumer software side, as well as small business and what we call very small business. So initiatives and tools that are designed to support businesses that maybe have 1 to 10 employees, or from 10 to maybe a couple hundred. Our consumer offerings are really interesting. We have platforms that scale into the tens of millions of users with a couple of our companies. And then, of course, the enterprise software tends to be cybersecurity, infrastructure software, data disaster recovery, backup. So we do see a broad array of different sectors in the market, and like all three of those sectors.
So one thing that I find very intriguing is what is happening in Utah. We've covered a number of great companies in Utah. That includes Pluralsight, that includes InsideSales, and we've also covered a lot of smaller companies, and many of them have been here at these roundtables also. So it seems as though there's a bit of a technology startup hub developing in Utah. Could you talk about what you're seeing, and what is the history, and why is this happening?
Yeah, no, that's a great question, Shamana. So I moved to Utah in 1988, so it's been a while now. But if you think about the roots of the state, you go back to that time frame, companies such as Novell and WordPerfect and iOmega, those are names that are really no longer around, but created the fundamentals, if you will, of a technology ecosystem here in Utah from the early days that have kind of continued to throughout today. You fast forward over a couple of decades and look at the development in the state, you've got some great fundamentals that are here that are really attractive to people that would like to be involved in these ecosystems. Number one, you've got a great quality of life. We've got beautiful mountains in our background. We only have 3 million people in the state. We don't have 40. So there's less stress on the infrastructure as far as quality of life. We've got great schools here in University of Utah, Brigham Young University, a couple of other community colleges that really spawn great development, great science and engineering, and just a growing ecosystem of technologists who want to live here. So the roots of the state in and of itself sort of bring us forward to a scenario where you have now thousands of companies that are now here and growing, and a fair amount of capital that's here to support those companies. So you have ourselves and 2 or 3 other firms here in the state that invest locally. We've got some really nice emerging seed funds that are allowing early stage efforts to get launched. And then we oftentimes attract capital from the Bay Area or from the East Coast. Once companies hit a certain critical mass and size, and you referenced a couple of them, whether those are Pluralsight or InsideSales, once a company hits a certain growth stage, oftentimes that attracts capital that comes from out of state that is able to write much larger checks to facilitate some of the growth that the seed funds, folks like ourselves and others have facilitated and helped drive the businesses to that stage. So, long story short, Shimano, we've got a great ecosystem here that's developing based on the universities, the history of the state, the entrepreneurial culture. So, there's a lot happening in Utah right now. It's an exciting place to be. I think anybody who's here is seeing it, sensing it, feeling it, and it's just a lot of fun. So we're pleased to be here. As mentioned, we don't exclusively invest in Utah. The thesis is Rocky Mountain region, so we do invest in the other states, as I mentioned, opportunistically outside of the state. But a good majority of our deal flow, I'd say 60 to 70% of the deals that we do and are in our current portfolio are going to be right here in the backyard.
A couple of points to add to what you said is I started seeing a bit of an inflection point in Utah after Omniture. Omniture was a very visible success out of Utah, and Adobe acquired, Omniture went public, then Adobe acquired Omniture, and that has been kind of one of the milestone and highly visible success stories. That's one, inflection point to note. And the other thing from a trend point of view that I have observed is that companies from Utah have done great bootstrapping. Both the companies, Pluralsight and InsideSales, were bootstrapped to a very large degree. They actually did not take much early stage capital at all. And by the time they took capital, that capital was, a lot of capital, and it's not a traditional Series A by any stretch of imagination. These were very large amounts of capital from Silicon Valley, actually, and they've, I think that kind of underscores the culture of your ecosystem, which is not at all the ecosystem culture in Silicon Valley. In Silicon Valley, people are obsessed with venture capital as early as possible, whereas I think, and this is, by the way, very much the philosophy of 1 million by 1 million, I think you have a more sustainable, basic cultural framework in Utah, which has its underpinning in bootstrapping as opposed to this, mad rush for capital as early as possible.
Yeah, no, I think those are great points, and maybe just to kind of respond to that a bit. So, there's been a couple different waves here in the state. I mentioned the early days of Novell, WordPerfect, iOmega. Those businesses thrived deep into the 90s, maybe early 2000s before they started to change. And then along came Omniture and I was CEO of a company called Phobos, which was acquired by a Bay Area company. So you had 2 or 3 or 4 other companies that sort of thrived in those early 2000 years. And then you had, of course, the Great Recession that slowed things down and caused sort of a dearth of capital and some changes in the ecosystem. And then the last 3 or 4 years, I think, coming out of the recession, there's been a lot of capital, there's been a lot of growth, and there's been a lot of enthusiasm for investing, back into the state. To your comment on, early stage investing versus, patient capital versus perhaps bringing in capital later on for growth, I do think the state in particular is known for probably more bootstrapping. Valuations tend to be much more reasonable here at the entry points than perhaps other areas in the country, and notably Silicon Valley, of course. So you do oftentimes see more attractive investments, at least entering, at the entry point. To your last point, if you look at Pluralsight in particular, I think they were probably 10 or 12 years old before they even brought in capital. So that's kind of an amazing itself as far as bootstrapping the business, having a different mindset, and then many of the dollars that have come into those businesses, both Pluralsight and I think InsideSales in particular, have been secondary transactions where the founders and maybe early employees took some capital off the table, and then there was a fair amount of money available to continue to reinvest into the growth of the company. So there has been some of that. I think in the last couple of years, we're seeing a little bit more of a traditional bent towards seed. The seed market here really growing. Series A investments becoming a little bit broader, a little bit more traditional. Valuations still being relatively reasonable in our opinion, which makes it a great place to continue to work and invest. But sometimes those change. Sometimes valuations can pop up and get a little bit more frothy, and we and others have to be, careful and balanced with the entrepreneurs as we look at the type of capital and what type of valuations that we're investing in. But
Ron, what is your definition of an attractive Series A investment? And I'll let me give you some color on what exactly I'm looking for here. So in Silicon Valley, a lot of Series A investors today in SaaS are looking for $1 million ARR already in place before people are willing to make Series A investments. And their expectation is the entrepreneurs have gotten to that point either through bootstrapping or through other kinds of seed investments, friends and family investment, whatever way, but they want to come in after the 1 million ARR mark is hit. And there are 2 kinds of funds we see. We see there are actually small funds that are willing to do $1 to $3 million investments and keep this in kind of like a capital efficient mode. And then there are these big funds who don't do $1 to $3 million investments. They need to invest in large chunks because they're larger funds and they can only manage so many companies based on how many partners they have, and they can't do these smaller deals, so they immediately want to put in lots of money, and then the whole game changes because you have to, you're basically the bar is much higher. So how do you define for me what is your definition of Series A? Is it small chunks of investment at mid, what is the threshold at which you would like to come in?
Yeah, no, great question. That $1 million in annual recurring revenue is a great benchmark. Do we always achieve that when we see something that looks compelling? No, but we want to see at least a path to that, and then potential hyper growth following those early stage years in the company's cycle. So I think we're looking for just as much promise of accelerated growth, and $1 million is certainly a nice benchmark that I think is fairly common throughout the U.S. But we tend to underwrite we always look at 3 key things. We look at the management team, we look at the technology, and we look at how big do we believe the addressable market is. And sometimes on that last piece you don't know for sure, but you are taking a pretty good estimate of how large you think the company's customer base could be. We take a lot of our cues from the management team. How strong is this team, whether they have had prior successes in startups or they are people that are coming out of larger corporations with just great reputations and great management skills. And of course, the technology is very, very important. If you're going to be a smaller entity here in Salt Lake or Denver or Phoenix, and you're going to try to change the world with your product offering, it's got to be excellent. It's got to be best-of-breed technology. And so those are the three things that we're typically looking for as we underwrite to an investment. And then we're looking for that, that growth potential to be there. So in summary, we'd love to see $1 million run rate. Sometimes we invest later. Sometimes we see a business that's doing 500, 600, 700, but looks like they have the promise to grow pretty significantly based on those that three-legged stool I just described as far as the underpinnings of our investment.
And what is a typical round size for you? How much do you like to put in?
No, we typically put anywhere in between $3 and maybe $5, $6, $7 million, and then reserve about the same amount for the investment over time. Our ownership structures tend to be between 15 and 25%. With that type of investment, our average check size up front is probably $5, $6 million, and then again the reserve would be a double on that. So we're looking to invest.
And so when you do a Series A in that order, are you the only funds typically? Because these days people don't need as much money, even though there has been a frenzy of raising too much capital. You actually do not need as much money. So when we're talking about a 5 million Series A, are we talking about a 10 million Series A because there's another investor involved, or are you the only money and you're willing to go at it alone?
Good question. We've done it either way, Sharmana. So we've gone alone, and then we've gone with the syndicate. And typically we like to syndicate our deals just because it brings more capital. It brings hopefully some broad-based thinking at the board level and some more expertise and depth in the area. When you're a Series A investor, occasionally you are just following a seed round by yourself, and then looking to make further syndicate expansion at the B level or maybe the C level, do A and B. But I'd say it's probably a mix. I'd say it's 50-50 at the A level. We have another firm at the table with us, the other half of that is we'll start the Series A ourselves and then look to grow the syndicate based on success of the business into the B rounds.
Let's talk a bit about what you're seeing in the Rocky Mountain area startups, especially in the early stages. So Utah, Colorado, Phoenix, in that general area. And you mentioned that you have 3 different practices, the enterprise practice, the small business focused practice, as well as consumer software practice. Can you give us some examples of interesting businesses that you have seen, invested in, that are representative of trends?
You bet. So let's start on the enterprise. We recently invested last year in a company called Rackware that has a very large presence here and also in the Bay Area. And that's a company that does disaster recovery, migration services, and public-private cloud offerings. So that's just a really interesting piece of technology. We've partnered with IBM with that company and are selling mostly into the enterprise for migration services and disaster recovery, cloud-based infrastructure technology. That's a really exciting company. They led that deal for us this past year, and that's an example, I think, on the enterprise side. On the consumer side, we've been in a company called WildWorks, which is based here in Salt Lake for a while. This is a kids game that is a virtual world between joint venture between ourselves and National Geographic. We've created a virtual world called Animal Jam, and we have about 40 or 50 million kids around the world that are participants in this platform. There's a mobile offering on tablets and phones, of course, and then you have a web-based presence. That's a lot of fun. That's an example of our consumer strategy where we have a focus.
And that's a subscription model?
That's a subscription model on the web, and it's also a in-app purchase model on the mobile devices. So it's a bit of a hybrid model. And so obviously you're seeing a lot of gaming and infrastructure technology in that world move towards either subscription or in-app purchase, and then there's obviously
free-to-play.
Right, when you're free-to-play, and then you want to get into enhanced services and offerings. That's when the subscription kicks in. So that's an example on the consumer side. Another consumer product offering we just invested in this last year is a company called Chatbooks. This is a really fun company that allows you to, every 60 photos you take, either on your phone or with Instagram or Facebook, you get automatically uploaded to a service that ships you a small scrapbook, if you will, that captures all of your memories. So instead of having all of your photos tied up on your phone and you're deleting, or maybe you don't get back to those, this service allows you to, in effect, receive a small little photo book each month just based on the photos that you take. And that business is in hyper growth and has been a lot of fun for us. So there's some examples, I think, on the consumer side and then on the enterprise side. On very small business, we've got a really large company in Arizona called InfusionSoft that we've been with for a while now. That's a business
We've covered InfusionSoft extensively.
Okay. All right. So the business
they have been around.
Small businesses for marketing initiatives and CRM.
The CRM. Can you adjust your phone so that the audio comes through? Sometimes you're just cutting out. You're just going very low audio-wise.
Okay.
InfusionSoft is actually also same model as what we discussed earlier. It's a bootstrap first, raise money later model out of Arizona, and they bootstrap quite a ways before they raise money from the Bay Area, also from you guys, and also more David Dow, I think, is in that company.
That's very good. That's exactly right. So I think those are some examples of investments that we've made in the past and some recent investments. I think we continue to see really nice trends across the enterprise sector, the consumer sector, as well as very small business. 2 years ago, we invested in a company called Eastman Networks, which is a cybersecurity company here in Salt Lake.
Mm-hmm.
We've got a fair amount of depth in the cybersecurity market. We like it a lot. We've had a couple successful exits in the past out of the fund. So that's another example of, I think, the continuing trend in the cyber world, albeit that world has become much more crowded, as you're well aware. There's a lot more attention and capital.
Very crowded. Very, very crowded. What about, talk to us about exits. What are some of the prominent exits from the Rocky Mountain ecosystem that you have seen, and what has that done to the ecosystem? Have these people stayed around and continued to work in that ecosystem as angels or repeat founders? What are the dynamics?
Yeah, we try to induce people to be repeat founders and like to see them stick around and maybe do one more with us after they've had a nice exit. It's been a pretty good couple of years for us on the exit standpoint. We just sold a company called C7 Data Centers just right here in Bluffdale, just south of Salt Lake City. While we didn't disclose that price, it was in a very attractive exit for the entrepreneurs and ourselves, and a business that had grown dramatically. We sold another company called Luxel Wireless last year to LeGrand, and LeGrand paid a little bit over $50 million for that business. Again, a smaller exit, but an exit that we had, where we had done very, very well. That was a business that sold, Wi-Fi technology, access points for the home automation market. So those are, a couple of examples of recent exits that have been attractive to us. A couple years ago, we sold a company called Solera Networks, which was in the cybersecurity sector. We sold that to Blue Coat Systems, who was ultimately acquired by Symantec. So there's been a fair amount of energy in our platform on the exit side, and all of those entrepreneurs have, recycled back into the community, whether with us or with another firm, and are looking to do it again. It's pretty rare that you see an entrepreneur here, maybe in Salt Lake, go become just exclusively an angel investor. Sometimes our exits, while they're compelling, they may not be billion-dollar exits that you see in the Bay from time to time. So our model tends to be a little bit different in investing in the region. We can invest at a lower entry point and sell a business for a couple $100 million, and everybody does very, very well. So it's somewhat germane to investing in these 4 or 5 states versus perhaps Bay Area investing that makes us a little bit different.
And do you have an estimate of how many, technology startups are operating in this corridor, in the Rocky Mountain corridor?
Oh, gosh. I would say, thousands, right? Literally.
Thousands?
think you would see between seed capital, Series A, across the region, literally, thousands of companies here that either a little bit more established or are getting started or on a 2, 3, 4, or 5 years into their journey. But I would put the estimate in those 4 states well into the thousands.
Great. Awesome. Well, thank you for enlightening us on your geography as well as what your activities have been. As I said, it's a trend that we have picked up, which is why we invited you to come and talk to our audience here, and we'll continue to cover them. So send us companies that are, we cover $5 million plus revenue companies in the Entrepreneur Journey series, and we'll be happy to feature more of companies from the region. Thank you, Ron, for being here.
Anna, thank you very much for having me. It was a pleasure to speak with you and talk a little bit more about our exciting region, and I very much appreciate the opportunity to spend the time.
Bye-bye. Take care.
Okay. Thank you. Bye-bye.
Folks, there are a few things that I want to do today. One of them is actually introduce you to my course on lynda.com and LinkedIn Learning on Bootstrapping. And I've been looking for an opportunity to do this at one of the roundtables for a while, but we're always full and I never can find that time. So what we're going to do over the next few weeks is to try to, slide in at least a module each so that we can also get some of the pedagogy into the process. So Maureen, if you could get started with maybe part 1 of the course, that would be great, and we'll do Q&A and discussions right after this video presentation.
One fine morning, you wake up, you decide that I want to start a company, and what do I do next? I need to go and raise money. Why do you think that? Because the whole media is talking about nothing other than venture capital finance. Investors do not fund companies until companies have some level of validation, some level of traction. So you are going to need to bootstrap your way to validation, bootstrap your way to some level of traction before investors are going to touch you with a 10-foot pole. Bootstrapping, in its simplest form, is building a business without any external financing. My name is Romana Mitra, and I'm the founder CEO of 1Mby1M, which is the first and only global virtual accelerator in the world. Bootstrapping is a cornerstone of the methodology that we use to help entrepreneurs become successful. I want to teach you today how you can use the tried and true principles of bootstrapping to get your business off the ground and potentially to great success. My name is Romana Mitra. I'm a serial entrepreneur in Silicon Valley. I have done 3 startups in the first wave of the internet during the 1994 to 2000, what is today known as the .com period. And I'm doing my 4th company right now as founder CEO over the last 6 years that is called 1Mby1M. 1M is the first global virtual accelerator. We run it out of Silicon Valley. Our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue. So my startup journey has happened from many, many different directions. First, I started my own company, first company as a graduate student at MIT. And then I did 3 of those in a row at a time when it wasn't so easy to learn about how to do startups from the internet, because the internet was just being built at the time. Today, it's a lot easier to learn about startups. People starting out have a lot more resources available. Then I did 10 years of consulting, working with more than 80 companies in Silicon Valley and also internationally, where I looked at startups from many different points of view. I looked at startups from the side of the entrepreneur. I worked with VCs in a consulting capacity, so I looked at how VCs look at companies, how they evaluate companies, etc. And I also worked with a lot of big companies and looked at how they look at technology and innovation and product marketing and so forth. So I've looked at the domain of technology startups and technology-enabled services startups from many, many different perspectives before I started 1Mby1M in 2010. And the reason I started 1Mby1M was my distinct feeling that capitalism was failing us. You know, capitalism today has developed this fortune at the tip of the pyramid structure. And I don't believe in this kind of a structure, especially I don't believe in capitalism as it has been hijacked by the speculators. I believe in entrepreneurial capitalism. I believe in entrepreneurs building value, building wealth. I don't really believe in this kind of, you know, casino game kind of capitalism. And unfortunately, we are at a phase of capitalism where that has become the dominant force in capitalism. So I launched 1Mby1M to address this issue and kind of take it to the fortune in the middle of the pyramid level, unlock the value that is locked in the middle of the pyramid by democratizing entrepreneurship, education, incubation, and really teaching what we have learned in Silicon Valley, the rigor and the methodology that we've learned in Silicon Valley, making that available much more broadly, globally, and you know, in a far more available democratic way. And that's the philosophy behind 1Mby1M. Bootstrapping, in its simplest form, is building a business without any external financing. So you are essentially offering some value to a customer or a group of customers, and they're paying you for providing that value. And what that translates into is revenue, basically. Customers paying you is revenue, and that is the money that is funding the organic growth of the business. This is bootstrapping. Now, if you hold that against what bootstrapping is not, it is not using a lot of investor capital. Investor capital is not revenue. Investor capital is either debt or equity. And investors could be all kinds of things. It could be VCs, it could be angels, it could be friends and family, it could be banks, it could be other kinds of financial institutions. All of those, however, when they participate in a company, in your company, they're going to be participating as equity or debt investors. And when you involve investors, you're no longer bootstrapping necessarily, you're basically using investor capital to build your company. One of the things that you will see very poorly reported in the media is that over 99% of businesses, of entrepreneurs who go out to seek venture financing get rejected. What that means is that if you want to be a successful entrepreneur, you kind of believe that you have to raise venture capital, which is a huge myth. Venture capital is not success. Entrepreneurship does not equal financing. Entrepreneurship equals customers, revenues, and profits. Financing is optional, exit is optional. As you parse what I'm saying here, try to keep in mind the criteria based on which VCs invest in companies. VCs are looking for companies that are ultra-fast growth, ultra-large total available market size opportunities. We're talking about billion-dollar, multi-billion-dollar business opportunities, and we're talking about companies that go from 0 to 100 million in 5 years. Very few companies have those correct characteristics, and the less than 1% of companies that do get financed by VCs and angels who feed into the venture capital ecosystem are looking for companies that fit that characteristics. So obviously, most companies get rejected because most companies don't fit that profile. But if you look at the world out there, if you look at the business problems, if you look at all the, issues that consumers are dealing with, there are, for me, for a person like me who lives and breathes entrepreneurship, there are entrepreneurship opportunities everywhere. And these opportunities can be $5 million opportunities, could be $10 million opportunities, could be $20 million opportunities, could be $50 million opportunities. None of those fit the venture capital model, but you can build a wonderful business with customers, revenues, and profits and have a wonderful life. That's why bootstrapping is so important. If you learn to bootstrap, you can build a business and have a wonderful life, and at some point in your cycle of building this business, it may make sense to bring in outside investors, and you can do that too. You can bootstrap first, raise money later. So we're going to talk about bootstrapping, and the reason bootstrapping is really important is even though the media has created this myth that entrepreneurship equals financing, and one fine morning you wake up and you decide that you're going to be an entrepreneur, that could not be further from the truth. You're going to have to bootstrap your way to a certain level of validation and traction and understanding of your business. There's a lot of words and terminology that you're going to learn in the course of your exploration as an entrepreneur. You'll learn product market fit and stuff like that. All that kind of needs to happen on your own dime. This is why bootstrapping is so important. The other reason bootstrapping is really important is that some businesses are not really venture financeable. That does not mean that they cannot be successful businesses. They still can be successful businesses, but the venture capital model is specifically designed for a very specialized class of companies. And they need to have two characteristics. One is they need to be addressing very large market sizes, market opportunities. And that, by large, I'm talking billion, multi-billion-dollar market opportunities. There are very, very few business opportunities that fit that characteristic. And then there's a second point that you need to be aware of is that VCs are looking for companies that are going to grow at an exponential pace. So you go from 0 to 100 million in 5 years. That's the kind of business venture capitalists are interested in funding. Again, very few companies have the characteristics of being able to go from 0 to 100 million in 5 years. So if you take those two criteria and transpose those on your particular business idea, the chances of your business idea fitting that model is not high. It's a very low probability game. But I really believe that there are many, many, many opportunities out there that are $5 million, $10 million, $20 million, $50 million opportunities, and perfectly sound, sustainable business opportunities. And you can build those businesses and have a perfectly wonderful life. So this is something you can do if you understand the principles of bootstrapping, and it just sets you free from this, false mindset that entrepreneurship equals financing. Entrepreneurship is not equal to financing. Entrepreneurship equals customers, revenues, and profits. Financing is optional. Exit is optional. So, I coach entrepreneurs on a daily basis. That's my life right now. For many years, that's what I've been doing on a continuous basis. And as a result, on a regular basis, entrepreneurs come and pitch me their ideas, and I work with them to help them understand how to take this idea forward, how to put one foot before the other. And I can't tell you how many times this particular scenario that I'm about to tell you about shows up in my life. Somebody will come in and say, oh, I want to do this. I want to do this app, or I want to build this software as a service, or I want to do this website, and people are going to use it in such and such ways. And I'm going to get millions of users, and then advertisers are going to start paying for it. Well, it's a long, long process and a very expensive process to get to millions of users for anything. And it costs a lot of money during that period. Maybe it will take you a lot of time. It's going to take you 12 months, 24 months, sometimes 36 months to get to millions of users. And the question that I always ask is, how are you going to finance that phase? You know, that 12 months, that 24 months, that 36 months, how are you going to finance that? Unless you're one of the founders of Facebook and you are sitting on $1 billion, then I don't question what you want to do. You can do whatever you want. Like Adam D'Angelo from Quora is doing that. They don't monetize. They just let you kind of use their software for free, their platform for free. And they are, you know, they have been able to finance that journey, but most people don't. And you're going to have to somehow figure out how to finance that journey. The other piece that you need to keep in mind is that advertising rates really, really suck. You get paid so little as advertisements. It's just not viable. Unless you have tens of millions of users, it isn't just not viable to make a living selling ads. And so then you have this chicken and egg problem, right? It takes a long time and a lot of money to get to millions of users. Investors are not going to fund you most likely during that period until you have proven traction. And to get to proven traction is a long, expensive process. This is why if you have dreams of getting to millions of users just like that, you need to really think very pragmatically about how are you going to get there. And if you come to me, I will give you lots of very pragmatic questions that I'm going to make you answer. I would ask you, what is the product? Who's going to use it? And why are you assuming that people are not going to pay for it? Why do you have to give this product for free? I'm not a big believer of giving things for free. I think, you know, the internet has been hijacked by free riders. So my guidance to you would be, do not build a business with the assumption that you're going to be catering mostly to free riders, because converting free to paid users is very difficult, and monetizing through advertising for all the reasons that I told you just now is also very, very difficult. So my guidance to you mostly, especially when you're bootstrapping a company, is going to be figure out what is going to be your business model, what is going to be your revenue model, how are you going to make money? What is your monetization path? And those are core questions that I'm going to make you answer. You know, when I started my startup career, 1Mby1M is my 4th startup. So I've done 3 before that as founder CEO. And my first 3 were actually at the height of the internet, the first wave of the internet, so between 1994 and 2000. So I was still a graduate student at MIT in 1994 when I started my first company, and then I did one startup after another all through the 90s. And during that time, because we were in this massive bubble, the kind of bubble that has never happened in the financial markets before, because internet was such a revolutionary technology, so new, and people just did not understand it. So people were willing to, you know, throw whatever against the wall and see what would stick. So this dot-com bubble, as it has come to be known as, was a time frame, it was the late 90s, roughly speaking, when you could walk into an investor's office with a PowerPoint presentation or whatever slide presentation, and investors would actually buy checks. So investors would be willing to write checks against pure concept presentations. We are in 2016. None of this happens anymore. That 1999 dot-com bubble did not last. You know, this kind of funding whatever the hell and seeing what sticks, this thing is out of the window. It's no longer happening. We are not in this ecosystem at all anymore. Today's world is far more pragmatic, far more down to earth. Bubbles are still happening. There's the unicorn bubble. The latest of our bubbles is the unicorn bubble. However, today one thing that is not happening is concept financing. So you have to be very, very conscious of the fact that do not predicate your business assumptions on concept financing. You're going to have to build a business and then get that finance. Your business, your concept, has to become a business before any investor would be willing to work with you and write you checks. So do not assume that you just can put the concept on a slide deck and investors are going to be willing to engage with you. It's not going to happen. If you cannot do concept financing anymore, and that is a reality that we are starting with here, that's the ground rule, then you need to figure out how to get your business off the ground. What do you do? How do you put one step before the other? That's the most important question in the journey of an entrepreneur. That 0 to 100K, I'm not even talking about 0 to 1 million, the 0 to 100K journey is a very, very complicated journey where you're fighting all kinds of chicken and eggs, and that's the journey that you're going to have to figure out a viable strategy for. My take on this phase of your journey, which is where I'm spending most of my time on right now with thousands and thousands of entrepreneurs all around the world, is you're going to need to analyze your business and validate your business. Do you have a value proposition for a set of customers, a segment of customers that really want to buy your product? Are you solving somebody's problem? And that could be all kinds of different problems. There is no hard and fast rule on what kind of problem can build a successful business. But you do need to find a problem for which people are willing to pay. And that's critical to get to in this early phase. If you take a validated business to investors, the likelihood of your getting money is much higher as investment. Better still, if you can get a validated business going with customers actually paying for it early on, that is the best way to build a business. And in fact, the beauty of that is that if you get to that phase of a validated business that customers are willing to pay for, and you have the other characteristics of business building that fit the venture capital model come together, then investors actually come chasing you instead of you having to go chase investors. So there's all kinds of good, feelings about businesses that are validated, that can find customers willing to pay for it, and the industry term for that is product market fit. So my advice to you would be try to get to product market fit as soon as possible before you go out to seek any kind of financing, if at all. Don't confuse a business model with a business plan. The term business plan is used for the overall business strategy and the manifestation of that business strategy in financials and so on and so forth. Business model is much more specific. Business model is answers the critical question, how do you make money? How does your business make money? That is a business model. Business plan is a whole lot of other things. It's a much bigger portfolio of things. So as you know, I constantly work with entrepreneurs, and they're coming up with sometimes the most absurd pitches, sometimes the most wonderful pitches, and everything in between. So one thing that comes up pretty often actually is somebody will come and say, oh, I have a brilliant idea and I want to do this. Great. All right. Yeah, sounds like it makes sense. What is your business model? Well, my business model is to get acquired by Google or LinkedIn or Facebook. A business model is not an exit strategy. When somebody acquires you, that's an exit strategy. That doesn't happen very often. If you actually analyze how many companies Google buys in a year or Facebook buys in a year, and if you combine all the companies that buy something or the other in the course of a year, the number is not that many. So you're trying to play an incredibly low probability game of predicating your business premise on spending, 6 months, 9 months, 12 months, 18 months, 24 months on the assumption that you're not building a business. You're just kind of doing this, that, and other thing with the anticipation that somebody's going to buy you out. This is not very sound business strategy. So please don't do it. The better way to do it is figure out a business problem that you're solving, that people are willing to pay for, so that you have an ongoing revenue stream coming into the business, growing steadily and so forth, so you become a sustainable company. You have revenues, you have customers, you have revenues, you have profits. Profitability is important. For survival, profitability is incredibly important. The only way you can circumvent profitability is with gobs of venture capital. And that, again, is a very low probability game, as I told you at the onset. Over 99% of the businesses that go out to seek financing actually get rejected, which means that you're going to have to most likely, the highest probability scenario for you as an entrepreneur is that you're going to be building a business without venture capital or any kind of outside financing. And at that point, profitability is a requirement for your strategy. Exit strategy is not. So you want to learn how to build a good, solid, sustainable business model. What is that? How do you come up with something like that? We go back to validation. We go back to understanding your customers' needs, your customers' pain points, and how whatever that you bring to the market is solving those pain points. And then the next level of validation is, are customers willing to pay for what you are offering? And then the question after that is, how much are customers willing to pay for what you're offering, and in what model, in what format? It could be a monthly subscription, it could be a lump sum fee, it could be an annual subscription, it could be a transactional charge, whatever it is. There are all kinds of different pricing models that are available in the market that I could teach you about, but you have to zero in on a pricing model that is acceptable for the customer window that you are, customer segment that you are going after, and get a sense of how much are people willing to pay for it. What is the impact of the solution that you're bringing to the table in addressing that customer problem? And those are the criteria of a good, sustainable business model. Let's talk about unicorns. Unicorns is a term that's used in Silicon Valley and now actually globally to define companies with a billion-dollar market cap. Not necessarily revenue, but billion-dollar market cap. Unicorns are very hot right now. There's a unicorn bubble. In 2016, there's definitely a unicorn bubble. And we are starting to understand the goods and the bads and the uglies of the unicorns, and I'll tell you a little bit about it. The reason I want to discuss this as a myth is that there is a belief that you should bootstrap if you're doing something little here and there. If you want to really do something big and high impact, you should take venture capital. This is not true. It is not true at many levels, and I want to kind of untangle all these myths for you in this session. First and foremost, you can build very large companies by bootstrapping. You don't have to have venture capital financing to build large companies. And I want to tell you a few stories. The first one is of an entrepreneur called Sridhar Vembu, who founded a company called Zoho. Zoho has been now around for quite a while, and they're doing over $300 million a year in annual revenue. This is not a small company. I'm sorry, $300 million of revenue is not a small company. Sridhar never took any outside financing. He's one of my heroes, Somebody who can develop a business that solves real problems, delivers real value, and generates $300 million worth of customer revenue, customer-focused revenue, customer-generated revenue, is a hero as far as I'm concerned. So that right there debunks the myth that you can't build something large and scalable with bootstrapping. The other question of valuation and market cap, Zoho is a private company. But if you were to take this company public, or if you were to even, fund this company, value this company in the private market, and private investors wanted to come into the company, this company would be at a minimum $3 billion market cap. So it is not just a unicorn, it's a mega unicorn, okay? This is a big, large success story by all measures, and it is a bootstrap company. And there are other stories like this. I have another friend, Girish Navani, who runs a company called eClinicalWorks. Girish has also built a $300 million revenue, not market cap, $300 million revenue, healthcare IT software as a service company. And that company also is private. If it were to be taken public or it raised money in the private market, it would be valued at a minimum $3 billion market cap, probably more, because these are both very high growth companies and very, very profitable companies. So please, if anybody tells you that with bootstrapping you can only build little companies, don't buy into it, because that's complete bullshit. There's one other story that I want to share with you, and that is the story of Right Now. This is a slightly different story, different flavor of a story. Greg Gianforte is somebody I met probably a good 7-8 years ago now. And Greg had built this company called Right Now out of Montana. Who built a software company out of Montana? But Greg did. And because he wanted to do this in Montana, in Bozeman, Montana, none of the Silicon Valley VCs wanted to give him money. So he said, okay, fine, keep your money. He invested his own money, $50,000 with his own money, and started his company in Montana. And he very diligently validated with customers, really understood what his customers were looking for, built exactly what his customers were looking for, and in 2 years went from 0 to $6 million in revenues. What that did was position him very solidly for external financing. Because when investors see an entrepreneur succeeding, they want to come to the rescue of victory. This is typical investor behavior. They love to come to the rescue of victory. So obviously, everybody is now chasing Greg to invest in him. And I have actually a favorite saying, which I'm going to share with you right now. This is the perfect moment to do that. Do not go to VCs as beggars. Go as kings. So when Greg went to investors, the market was very high. This was 1999, actually. Market was in a bubble. He raised his first round of financing at a valuation of $130 million. Normally, people raise first round financing at $2 million, $5 million. $5 million is considered as a very rich first round financing valuation. He raised first round of financing at $130 million valuation. Right Now was a very successful company. It eventually went public and finally was acquired by Oracle for $1.5 billion. So this is a unicorn company that bootstrapped first, raised money later, and was a resounding success across the board.
So folks, as you heard from Ron earlier, his fund and many other Series A investors are looking for companies that already reach $1 million ARR, annual revenue run rate, before they're willing to put in money. So as a result, the early stage part is best done with either pure bootstrapping or a combination of bootstrapping and some kind of seed investing. And there's all kinds of complexity developing in the seed, pre-seed stage as well because of the Series A gap and the Series A pushing further and further out. So you have to keep all this in mind, which is why I am harping so much on entrepreneurs being aware of A, the importance of bootstrapping, and 2, the mechanics of bootstrapping. So we will continue discussions and methodology discussions on bootstrapping as we go along. Folks, do you have questions? I would be very willing to take some questions right now. I'll tell you more about how to use the 1M1M program also in a moment, but please feel free to ask questions, and I'll be happy to take your questions at this point in public chat. Anybody? William Mansfield is asking, how often do you get pitched? William, we are getting pitched all the time on a regular basis. There's a huge number of people who come in asking for my time, and we either listen to those pitches during these roundtables, or we ask them to, if they're not comfortable pitching in public, some people don't want to pitch their companies in these public roundtables, in which case our advice is to go, join the premium program, and I'd be happy to work with them. That's pretty much the way we work with the people who are pitching us. Terry Dan is asking, how does one protect ideas? Folks, make sure you set your public chat to send to all participants. That way everybody can look at the questions that you're asking. So Terry, how does one protect ideas? Well, if you have something that is patentable, you can file for a provisional patent application, which is not that expensive. A full patent expensive, but a provisional patent application is not that expensive. Very often, though, what we see in the industry, especially in the software industry, is the protection is more an execution game. And if you are doing something that is very easy to copy, our advice to you will be don't bother, because if you don't have anything that is an unfair advantage, something that you can do better than others, and some insight that you have that is more specific to you and that gives you a leg over others, it's going to be difficult because you're going to have to get into the market as soon as possible. Time to market is important. Getting into the market, talking to customers, talking to influencers is important. And the minute you do that, you're exposing your ideas anyway. So if it's very easy to copy, then you're going to be in trouble. William Mansfield, I mean, you are a startup, and I imagine people watching want you to use their services. Oh, you mean pitched as a customer, as a potential customer, all the time? Absolutely, all the time. Kari has a question, how to get prospects to finance development of a product or a service if they do not know you? Well, Kari, that really depends on how well you have identified a pain point, a customer pain point, and how anxious is that customer to solve that pain point, and how many options does that customer have to solve that pain point outside of you. And if you are the most obvious solution to that pain point, then they will work with you. They don't need to know you from before. They'll get to know you through the process of exploring the solution. Folks, keep your questions coming. We'll take more questions. And if you like what we are doing here at 1 million by 1 million, please refer the program to serious entrepreneurs. We are looking for serious entrepreneurs who have the tenacity to build businesses over the long haul. Now, I'll take you through a bit of the different resources that you can use to further your own learning through this program. You can follow our blog on the website. It's free and it's very, very rich. You can learn a lot through just following the blog. We also have the Entrepreneur Journeys book series that's on Amazon. There are 12 volumes, and you can double-click down on any of the topics that are covered there. They're case study-based books, 12 to 16 case studies each. You'll learn a lot just by going through those books as well. These roundtables happen every week. We've done over 350. The full acceleration program for 1M1M, and some of you here are already in it, is our premium program, the 1M1M Premium. And that offers you extensive methodology guidance, a full curriculum that is taught in video lectures and case studies that gives you the methodology. And then we do these kind of private roundtables, but they're private members-only sessions. That's where we do the strategy consulting, mentoring, coaching, whatever you call it. We help you with business development. We have a tremendous network, and we connect you into that network. You can meet customers, channel partners, investors, media, analysts through our network. On investors, though, we will introduce you to investors, but you have to be financeable before we do that. And it has a whole specific set of criteria. You need to have your ducks in line. We provide you with templates. We provide you with all that criteria. We help you fine-tune your pitches and so forth, and all of that is part of the premium program. And then we have a lot of clout in the media, so we can get the word out about your product or service, and that's very helpful because you need social proof to sell your product or even your company to investors, and getting stuff written about you, getting buzz generated about you is very helpful in getting out there. We have a 1M1M self-assessment on the blog, on the website, and that's free. We recommend that you take a look at that and ask these questions of yourself. These are questions that investors would ask you, but we want you to ask these questions of yourselves. You are the first and most important investor in your venture. So you should be asking yourselves answers to these questions. If you have methodology gaps as you're going through the self-assessment, try to plug those methodology gaps. One way to do that is signing up for 1M1M Basic, which is $99 a month, and you can have access to our entire curriculum, and you can just study whatever you need to study to fill your methodology gaps. That's pretty much it. You can dig around on the website, look at the program descriptions. There are lots of FAQs, video FAQs, etc. Description of the curriculum. The curriculum is taught in case studies and video lectures. We've had over 750 successful entrepreneurs participate in the case study program, and they've shared their journeys, their methodologies, their learnings, their lessons from the trenches, and you get to stand on the shoulders of so many entrepreneurs who have been very generous in giving you their, playbooks. This includes, by the way, 50+ unicorn entrepreneurs, a whole lot of about 400 venture-funded companies, 300+ bootstrap success stories. So you get to look at entrepreneurship from many different angles and learn strategy from many different types of entrepreneurs. Our methodology is, as I said, lean, capital-efficient, bootstrap startup. So you're going to be schooled in a model that gives you the highest probability of success. There are roundtables pretty much every week going forward. So pick a session, and if you want to come and work on your project, we'll be happy to do that at one of these roundtables. So the line is now open, and I believe there are a bunch of questions in public chat. Let me take the questions from public chat, and you're also welcome to call in and chat if you like. So Carrie is reinforcing the point, if pain is hot, they have not many options, the odds are high. Great. Yeah, that's correct. Samuel Brown, is this just limited to IT? I'm working with a guy who has just received the prototype for his product, and we are looking for more than money. Well, this program is limited to IT and IT-enabled services. We don't do clean tech, we don't do biotech. So, Samuel, if you tell me more about what is it that your prototype is about, I'll be able to tell you more about whether that applies. Our program definitely is a lot more than money. It's not just, money is an optional piece of the equation, actually. It's the knowledge and the guidance that is the core of the program. Anil Kumar, we have started working on our product as a B2C offering, and we do have a B2B offering in our roadmap. Recently, we went live with our B2C offering. and struggling with user acquisition. Suddenly interested investors are suggesting us to create a B2B solution. How can we go about these kinds of advice? Our intuition tells us to go with B2C, and when we're hearing many people suggesting us to go for B2B, sorry for a long question to cut short, do we listen to advice at the beginning when they want us to change the fundamentals of our business and roadmap? Anil, I cannot comment on this without looking at your pitch. So my recommendation is sign up to pitch at one of the upcoming roundtables. So this is the roundtable schedule. Go to the website free roundtable page and come and pitch, explain what you're doing, and I will give you my perspective on what I think is the right thing to do. You're going to do next week. Great, excellent. We're going to work on your venture next week and figure out the answer to your question. Samuel Brown, the product is a hair dryer that has resolved the discomfort that ladies deal with the current dryers on the market. It also cuts the drying time by 50%, by a minute, 50%, okay? So these kinds of products often are great to sell on the internet, at least to begin with. These are great products to sell on the internet. So we have a lot of niche e-commerce businesses that we work with, as well as we have lots of case studies. So this is something that we can help you with. We have a lot of methodology around how to bring products like that to market. E-commerce is very much a part of our value proposition. We do a lot of e-commerce. E-commerce, enterprise software, small business facing software, any other kinds of, internet online businesses are perfectly okay for the program. So while you're coming up with your other questions, let me also introduce you to Irina Patterson. If you have other questions on the program, please feel free to reach out to Irina, and she will answer all your questions diligently. Anybody else? Any other questions? And some of you have introduced yourselves. William Mansfield is dialing from North Carolina, socialhaven.com. Samuel Brown from Charleston, South Carolina, owner of PacketX LLC. Anil Kumar from India. NGRIP is the company platform to bring non-formal learning to resume. Is that? Crystal Mundo from Miami Beach, Florida. Crystal Milan, and the founder of Thrive Creative Business Coach, help entrepreneurs with the business side of their craft, provide leadership training to small and mid-sized organizations. Anybody else? Any other questions, comments? If not, we will adjourn and we'll meet back here next week. If you would like to work on your business, please feel free to sign up on the website under free public roundtables, and we will pick it up from where we left off today. Thank you for coming, and we look forward to working with you and on your businesses. Thank you. Bye.